Stocks climb in the run-up to the union budget despite soft overnight queues with the US Fed pushing out a possible rate cut. Realty and oil and gas are the big gainers, while consumer durables and IT are the big drags.
Tata Motors misses profitability estimates by a wide mark, and while it holds on to JLR's margin guidance for the year, worries over demand and growth in China and Europe are a big worry for analysts. The stock, on the back of that, slumps.
After trimming its stake down to 51% last year, Whirlpool plans to pare its stake to 20% in its Indian arm, reducing it to a minority investor. High relative valuations and the need for cash are likely drivers, but the move leaves shareholders in a whirl. The stock is down 20%.
SEBI spells out what amounts to violation of its rules that bar registered entities from engaging with unregistered parties, read finfluencers, offering stock advice or masquerading as investor educators. SEBI says it could suspend or debar violators. You're watching us here on Halftime Report. Good going for the market. Well, it's up and away. In the last couple of trading sessions, we've seen a near 500-point rally on the Nifty itself. But it's important to know that as we move forward, could there be some sort of selling that comes by at the higher levels? The reason why I say that is because, one, it is expiry, and secondly, we are going into an event which starting tomorrow, which is the economic survey, and thereafter there will be the budget. So all those factors keeping in mind, the market's doing well in today's trading session, but how well can it do from here on is the big question. I'm Manglam Malu, with me, Hormaz Fatakia. Hi, Hormaz.
Good afternoon, Manglam, and it indeed is a good afternoon. It's been a good last couple of days for the benchmark indices, and in the market too. The index still hovering around that 20-day moving average is the Nifty. The Nifty Bank as well facing a similar trajectory. As Manglam just said, it is the monthly expiry today, so we'll need to keep an eye out for any potential volatility that comes in the second half of the trading session. But the focus before going into the budget has been on earnings. Good earnings getting rewarded, bad earnings / bad news getting hammered, as is the case with stocks like Voltas. The stock is down 12% after its results that were a miss on expectations despite returning to profitability compared to a loss last quarter, 11.5% lower there. Whirlpool, as we just mentioned in the headline as well, down 20%. After the promoter announcing plans to pare down stake further. It's been in a lower circuit since the start of the session, and it remains at that. But the star of the day has been Hitachi Energy so far, a 20% upper circuit today after some good numbers and some very positive management commentary as well.
We'll talk about that as well. And, to power the market ahead, we have some milk numbers coming in. Dodla Dairy up 56% on the net profit. Margins have taken a slight dip year on year, but I reckon the revenue would have grown. Yeah, revenue growth of 21% in a sector which is partial growth. This is a good, growth that we've seen as far as Dodla Dairy's revenues are concerned. 21% growth out there. My sense is that it would be led by some of their market expansion, capacity expansion plans, milk prices increasing itself, and significant contribution coming in from value-added products. So we'll keep an eye out on Dodla Dairy and other dairy companies as well, though we got some poor numbers from Hatson Agro earlier in the week. Hormaz, but you want to talk about Whirlpool a little bit, because you did allude to that being down about 20%, and we know the management the promoters first sold their stake in February. Thereafter, the stock actually rallied, and then now they want to sell more. What exactly is happening here?
Very interesting developments that are taking place. Earlier this morning, Whirlpool Corp reported their numbers in US hours and extended trading, and they announced that they are going to decrease their stake further in the India entity down to 20%. They do this either by the mid or by the end of this year is what they have said. Now, at the start of 2024, the parent entity had 75% stake. Then come February, they sold around about 24-25%, brought it down to 51%. And now from 51%, they intend to bring it down to 20%. So there's a further dilution that the promoters are likely to do, which is the parent company. Now, in February last year, they had sold that 24.7% stake in the block deal that was valued at around about 4,000 crore rupees. They sold that stake at an average price of 1,280. So after this 20% fall, the stock is now below the average price of that block deal itself. Now, why did they do so? Well, they said that they are going to use these proceeds to pare down their debt and strengthen the balance sheet. And for this year in 2025, they intend to bring down debt by a further $700 million is what Whirlpool Corp said in its earnings release last night. Now, and they had their reasons as well, right? Mark Bitzer, who's the CEO of Whirlpool Corp, he was on CNBC network at the end of the stake sale in February of 2024, and he mentioned that when the parent entity is trading at a 50-time multiple and your own company is trading at a far less valuation, it is an asset arbitrage, and that is what it is. They took some money off the table, but they remain confident of the prospects of the India business going forward, and that valuation point still holds because even today at the current price, Whirlpool India is trading at a price to earnings multiple of 41 times. And the parent entity is trading at 9.5 times. So it shows the valuation gap that comes in as well. And as you mentioned, the stock price also had rallied quite a bit after the stake was sold. At the closing of February 19, the stock was priced at 1330. By October of last year, the stock was at 2450, and then since then the stock has corrected almost 35 to 40% from those levels. Now, in shareholding terms, well, after the promoter sold its stake, that stake was increased significantly by mutual funds. They held around about 31% stake in March, which is down to 28% at the end of December. FPIs have increased their stake to around 3.5% in December of 23 to around 10% in December of 24. But the retail investors have not, they've chosen to stay away from the stock despite this massive supply that came in to the market as well. So as of now, if the stake sale happens, the minority shareholding, the shareholding will drop to 20%. That will make them a minority shareholder, and as a result of which they will not be able to block any resolutions if the stake falls below 26%. And what they also said is that the stake sale is for a greater autonomy for the India entity, but it will continue to remain a relevant part of the business. But the street does not like it. It's an overhang that has come in now, and as you can see in the price, down in a lower circuit of 20%.
It's an interesting overhang. If they take their stake below that 20% mark, does it make it susceptible to some other activity in terms of, a hostile takeover, etc., or not, is one of the questions that we'll keep an eye out on. But that is for the time when the stake is sold itself. For now, important to know, who on the other side is when it comes to Whirlpool buyers. No dearth of demand yet, but at the same time, no dearth of supply in the market too. But speaking about markets and specific stocks, Bansal Wire is the first management on the show today. The company reported a good set of numbers. The revenue surged by almost 54%, margins expanded as well. Stock holding up with a gain of almost 2.8%. Pranav Bansal, who's the managing director at the company, joins in now. Pranav, thank you for joining in. First up, what exactly was your volume growth in the third quarter? If you could detail that for us. And where does the capacity utilization of the company lie at right now? If you could give us a sense of the volume growth for the third quarter, the outlook here, and the capacity utilization.
Sure. So the third quarter has been quite eventful for us. We came up with a lot of new products, and definitely there was a lot of consolidation that happened within the group as well. Therefore, you see a good jump in revenue as well as EBITDA number. As far as volume is concerned, we were at about 92,000 tons of volume in the last quarter, which was significantly higher by about 50-60% if you compare it with last year.
All right, and the capacity utilization for the new Dadri unit, because I believe a lot of this volume growth would have come on the back of increased capacity as well.
Absolutely. So the new Dadri unit, which was set to start within this year and is going as per plan, we are already at 25% kind of a capacity utilization. So out of the 92,000 tons, about 7-8% has come from Dadri, which is only a start. Dadri, as you might know, is a plant where we are looking at least 3.5 lakh tons of capacity, which has already been installed. Out of that, we are utilizing 20-25% already.
Pranav, firstly, good afternoon. Thank you for joining in. Now, what are you expecting in terms of volumes for the next financial year? There's a report from Investec which says that you will be around about 5.05 lakh metric tons in FY26. Do you believe that it is a fair assumption that the brokerage is making, or do you expect to be much higher than that estimate?
I think it's a fair assumption because we would already be at 6 lakh tons of installed capacity by the start of next year. So, and looking at our volume trajectory right now, if everything remains the same, we should be able to achieve those targets.
I have a two-part question. One is, as utilization at Dadri increases, do you see better margins? What's your margin metric that one should look at, either in EBITDA per ton or, absolute margins per se? If you could give us a sense of that for the end of this year and next year. And at the same time, if you could give us a sense of how your export contribution is likely to be. Last known, that number was close to 11.5%. You were tapping some export markets. So on margins and export contribution, what's the guidance?
So as far as export is concerned, although we took a dip 2 years back in export, which was growing at about 100% every year before that, we are now back on track, I would say. Absolute numbers also, there's a good increase in Q3, and the next quarter and the year ahead looks positive for exports. But with that being said, the kind of increase that we are looking at as a company, I would not say in percentage term export would be any better here. Apart from that, when we come to margins, the right matrix for us is EBITDA per ton. But even that varies because of the 5,000 different products that we today manufacture. All those products have a different kind of an EBITDA level and a different product share within our portfolio. Going ahead, we are looking at ramping up low carbon wires, which is relatively lower EBITDA margin products in terms of EBITDA. But in terms of our return ratios, they are similar. So for next year, our focus would more be on volumes and top line. Our margins might reduce slightly, but in absolute numbers, even they would grow.
You said your margins will reduce slightly. Would you quantify that? If you could give us a number, by how much?
It's hard to say today, depending on the product mix again, because it's all in percentage. In terms of absolute numbers, we are still looking at a good increase in margins.
Can you define good increase?
So if you look at our numbers or our volumes today, we are at about 95,000 tons. And for the next year, we are looking at 5 lakh tons of volume. So you will see a 20-25% jump in volumes for the next year. Although it would not 100% correlate to EBITDAs, but it should give you a fair indication of where we are looking at.
So the EBITDA will grow just about in line with the volume growth, as against further than it, or maybe lower than it as well, or maybe about 80% of that, roughly, because there would be higher contribution coming in from lower margin products.
Yes, absolutely. So therefore, EBITDA might not increase at the same pace as revenue, but there would still be an increase.
One final question from my end, Pranav. Your finance costs have moved to around 7 crore rupees a quarter. You had earlier mentioned that you would become debt-free post the IPO. Now that your expansion plans are coming into place, are you planning on taking on more debt, or do you expect that finance cost to remain at that level as 7 crores a quarter, or do you expect that to trend down?
So actually, the current finance cost is also increased only because of revenue numbers. We've done a 30-35% increase in our revenue because of the consolidation also that has happened within the group. Going forward, there is no major capital expenditure that we have planned. The main capex was for Dadri, which we have already incurred. So there is no major capex that we look at in the next 1.5 years. If there is anything, I am sure we should be able to fund it with internal accruals and a very reasonable amount.
You said low carbon will increase in its contribution. It's currently close to around 57%. How does that product mix of the company change over the next couple of years? And what's your targeted return ratios? Because the first half you've done 17% ROE, 23.5% ROC. While it's a low margin business, it's a high return ratio business. So where do you look at your product mix and return ratios?
So, in fact, this is the right matrix for us to quantify our margin. We look at our return ratios more than the percentage of EBITDA or per ton EBITDA that we make, because that's the only thing that really matters, right, at the end. So, our return ratios is something that we focus on every day. And even for the year ahead, I would say we are looking to expand those further, whether it is ROC or anything else.
And, you are giving us directional indicators. We're looking for some ranges as well. You said that, yes, EBITDA will not increase as much as volumes, 20-25%, 5 lakh tons plus the volume that you're talking about. But if you could give us a sense, would we see mid-teen sort of growth in EBITDA? Would we see a couple of 100 basis points improvement in return ratios? Just directionally, if you could give a sort of range to the street as well, that'll be great before we let you go.
So our target for ROC is to always remain above 20%.
Okay.
Which is what we are aiming for the next year. As far as EBITDA is concerned, it will depend a lot on the market situation there. Definitely, we've taken a call where we do not want to sacrifice any volume growth because of slight margins. So we are ready to compete on margins front, but to gain on volume. Therefore, there should be some decrease in per ton EBITDA as well, but of course compensated by higher volumes.
All right, Pranav, thank you so much for sparing time and joining us today. Wish you good luck on the road ahead for the company. That was the management there of Bansal Wires, 4% higher on the stock after its results at 414. Time to take a short break, but before we do that, here's some good news for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips, as Mangalam is doing so just right now. You can download the app just like he has from the Apple Store or your Google Play Store, or just scan the QR code that's just come up on your screens. Take a short break, back on the other side. Welcome back. Continuing with our series of corporate conversations, Aarti Drugs is the next management on the show. The company reported a weak third quarter. Their margins also came in on the healthier side, but the API segment continues to witness some pressure. To discuss this on the road ahead, we are being joined by Adish Patil, who is the CFO of the company. Adish, good afternoon. Thank you for joining in. You start off with the API segment, right? You also mentioned that it continues to face pressure because of pricing and because of weak demand as well. So just summarize this for us. What are the trends that you're witnessing on ground currently? Has pricing improved by any means, or has even the demand situation improved?
Yes. So mainly, if you look at the December quarter, the export demand was quite good. It was healthy, and that is why the gross contribution actually improved for December quarter in API segment. But in domestic market, the antibiotic segment did not do well, and that was the main reason why there were a little bit fall in volumes as well, as far as domestic market was concerned. But export is doing well. And as far as the pricing scenario is concerned, if we look at YOY numbers, December 24 versus December 23 quarter, there is hardly around 2.5% negative price variance. If I compare with the September quarter, Q on Q, again, it's limited to around couple of percent negative price variation, and mainly on the account of antibiotic segment. But in some other products, in fact, we have also seen some upward trend in the prices. And going forward, if the sanctions on the Russian crude is implemented strongly, and if the crude goes up, then we might expect a little bit of upward trajectory in the solvent prices, intermediate prices, and hence the API prices as well.
Right. I was just hanging there. We have some comments coming in from SRF as well. They are positive on the HFC business going forward, in the fluorochem, outlook at least, and the packaging film as well. They believe that this demand-supply imbalance will continue, but will soften. The stocks move to the high point of trade on that itself. But let's get back to our conversation with Aarti Drugs. Adish, when you started the year, you were looking at 7 to 10% growth when, the prices were anticipated to fall by about 5 to 8%. 9 months of this year, your revenue is actually down 10%. And like you pointed out, prices haven't changed much from last December to now. It's down about 2% or so. Yeah. What does that do to your guidance for this year? Are you still hopeful of double-digit revenue growth this year? Looks unlikely. And what's your target for next year?
Yeah. So what happened this year was that though the prices are negative 2% for December quarter, but for the first two quarters, that is June and September quarter, the negative price variance was quite high, around 7 to 10%. And that was the main reason why the overall revenue did not do well, mainly because what volume growth we were expecting did not come. And main reason for that we account to the export market in the first half of the year. because of a lot of elections, the tender business was not that high, and in turn, we did not get any API demand for the exporting the API, and that was the main reason. And the second main reason was our salicylic acid plant. We had commenced the plant in the beginning of the year itself, but because of the teething issues, we were not able to scale up that. And had we be able to scale up that, then the volumes would have been really good. So those were the major two factors why revenue did not do well. So as far as this year is concerned, though March quarter might do well in terms of volumes, but overall we will see flattish revenues, as you correctly pointed out. If we look at FY26 projections, then if we considering that the salicylic acid plant will be well on track, and also the Saika plant will be coming online in this quarter itself. So both those plants operational, probably we can have healthy volumes next year, around 15 to 20%. Let's see, we hope so. There might be a slight negative rate variation of about 2 or 3% for the entire year, considering the first half of the year had better prices in FY25. So overall, probably, in mid-teens, we will try to achieve the revenue growth for next
Very
year.
interesting. Mid-teens is what you're trying. But you said that this year you will end flattish on a revenue basis. But that also puts a lot of pressure in the fourth quarter, because the first 9 months your revenues are actually down 10%. So you're confident of doing flat also, which means that you'll have to grow a lot more.
Yeah. So it is definitely challenging. But the positive side is our salicylic acid plant, the teething problems are over. So that we have, first of all, I would like to point out that this process for salicylic acid was developed in-house. And that is the main reason why, it took so much time to scale up at the plant level. But finally, we are able to do it. So we have already scaled up in the month of January, and February and March, it will go up and up. And definitely it will add to revenues, but then, probably we might fall short of achieving last year's revenue numbers, as you correctly pointed out.
That if is a very big caveat, right, Adish? You mentioned that you will grow at least back to flat growth on the top line front by the end of the year. What about margins? Where do you expect to end this year? And what about FY26? Because you say that you are confident of 13 to 14% margins. You're currently at 11.5. What will contribute to that margin expansion from 11.5 to say 13 or even 14 for that matter?
Yes. As if you talk about margins, so there are three main reasons. One is that because of the salicylic acid, we have been taking quite a bit of hit on our P&L. We were expensing out everything. So now that teething trouble is over, even if you do break even, it should improve the EBITDA margins by more than 0.5%. And plus, if you go in positive, then it will definitely add on to that. That is one main reason. Second main reason is the Saika plant. Now the Saika plant, that process is not in-house. So it is a proven technology. So we don't expect so much teething problems for Saika plant as we saw in the salicylic acid. And that is a backward integration project, basically the methylamines products. So that will definitely help our gross contribution, because anti-diabetic segment is almost contributing around 12 to 14% to our standalone revenues. So it's a big chunk. And plus we'll be selling those spec chem products outside at the outside market as well. And the third is the higher contribution of exports. Now we also got USFDA approval, which is a very big achievement, because we were under import alert almost 10 years now. And that was not only hampering the US sales, but also the European sales from that facility. So once we go more and more into regulated market, the margin profile is quite different than what it is in the ROW market. So that should also help us grow the EBITDA margin. So that is why we feel that 14% upwards is fairly reasonable to achieve in the next financial year.
Well, that's quite interesting, because when we spoke to the analyst on you getting the USFDA approval, they said that this plant could do revenues of almost 60 to 80 crores on a full-fledged basis. Just a final question before we let you go. You had said that formulations would double as a proportion of your overall sales. Instead of doubling, it's actually declined from the last time we spoke. It's about 8% of your overall sales. So where do you see this number going? And what happens to your 4,500 crore revenue target in 3 years, which when you said meant that you'd reach that number by FY28? Are you still targeting that?
That 4,500 would be slightly revised down to around 4,000 crores because of the current rates, what rates are ongoing. But if the rates goes up again, then obviously that number is still achievable. But considering the current rates, it should be revised down to around 4,000 levels at the console level. As far as the formulation business is concerned, definitely we saw a bit of hit in the December quarter. First of all, we would like to point out that even at the formulation side, we got US FDA approval for the first time for our oncology segment. And we also got UK MHRA approval for our oral solid dosage facility in the same vicinity. So, and plus our export is currently around 47-50% of the total formulation revenues, the formulation exports that is. So we definitely, and we have a lot of
Right. We were getting some more details from the management. Unfortunately, there was a glitch in the feed, but we did get the management's confidence of getting mid-teens volume growth, margins upwards of 14% in the next year. And hopefully formulations business also picks up as they've gotten out of the regulatory, or they've gotten regulatory clean chits from the US, and that will impact some of their business in the Europe positively as well. The stocks moved to the high point of trade on the conversation that has come by from the management, though the first 9 months of this year have been rather weak for them, and they will struggle to reach last year's revenue this year as well. But with that, we'll talk about Growth Code, an initiative by Grow and CNBC-TV18 offers valuable insights on strategies that may help you make well-informed trading decisions. This week, in an exclusive interaction, CNBC-TV18's Prashant Nair interviewed SEBI's whole-time member, Mr. Anant Narayanan, and asked him about the risks of overtrading.
Markets are all about activity, and we track it every day. But SEBI, you publish so many papers which kind of show overtrading and the risks of overtrading, and also just, the chances, the probability of actually what percentage of people make money. Just pure trading, right?
Sure.
So just talk to our sort of audience regarding that. What is your own perspective? Are you saying the more you trade, the less you make?
Absolutely, Prashant. There is plenty of research to suggest that at an individual level, precisely what you said, the more you trade, the less you tend to make. And there's a very rational explanation for this. Every trade comes with transaction costs. There's typically intermediary charges, there is taxes, there is exchange fees, and a whole bunch of things that go with every single trade. So the odds are stacked against overtrading.
Typically, nobody talks about those things. You just look at, you bought something at 10 rupees, I've sold it at 15 rupees, well, this is what I've made. But there is all these other things which you spoke about, right?
That's
you must take into account.
That's right. And there is plenty of research, both at a global level as well as at a India level, which suggests that the more you trade, the less you tend to make. For instance, we did an analysis in SEBI, which looked at the activity of intraday trading. So those who took part in intraday trading, what we found is that over 70% of those people tend to lose money in those trades. In January 2023, we found that 89% of all individual traders in F&O markets tend to lose money. When we updated that research later in 2024, we found that 93% of individuals over the last 3 years have actually been losing money.
Welcome back. Key indices holding on to gains, but still off highs for the Nifty Bank as well as the Nifty. So we'll keep an eye out on that as there is expiry. So good time to get you the F&O perspective. The key levels to watch for the market will be both the 20-day moving average on the Nifty Bank and the Nifty. The Nifty Bank has conquered that, is sitting above that. So that will be an important support zone to watch out for. For the Nifty, on the other hand, that will be a resistance zone to watch out for. Today's high on the Nifty corresponds very closely to the 20-day moving average there itself. Meanwhile, just keep an eye out on the 23,300 call. That's fairly active, 44 rupees premium, telling you again 23,350 would be a bit of a resistance zone to watch out for. At the lower level, though, the highest open interest is at the 23,250 put. And we continue to see writing that telling you around 23,185 to 23,200 would be the support for the frontline index. For the Nifty bank, it's the 49,300 and 49,200 calls, both of them extremely active. So sustaining above 49,350 would be extremely crucial. Whereas the lower level, 49,000 put, has the maximum interest. So that is something that we'll watch out for too. Take a short break, come back. On the other side, we have the management of Radico Khaitan joining in to detail their third quarter earnings.
Welcome back. You with us here on Halftime Report, continuing with our corporate conversations, and we are now being joined by the management of Radico Khaitan. And the company reported a good quarter, and now we are being joined by the company's managing director Abhishek Khaitan to discuss the third quarter performance. And Abhishek, thank you for joining in. Abhishek, you know, Radico, it's a strong quarter this time around. You could please run us through the key drivers that you've seen this quarter.
October-December quarter for Radico has been absolutely a fantastic one. After a long time, we've seen the volume coming back and the consumer demand picking. In fact, our volume growth for the current quarter has been 15%. And most importantly, our P&A has grown by 17.7%. And Radico has registered the highest ever sales in any quarter, which is 1294 crores. Our volume also has been the highest at 8.4 million cases. And also our EBITDA has grown by 30% to 183 crores from 142 crores. And also our PAT has increased to 95 crores, which is 30% over the corresponding quarter.
You know, the contribution from Prestige and above was closer to 76% last quarter. This time it's come down to 72.5%. Why was there a slight decline? Can you help us understand this? Because, you know, we've seen this trend reverse in all the other companies where the Prestige business is doing a lot better.
See, if you actually see our regular brands were degrowing, and this is the quarter where the volume has come back, and our regular also has grown by 13%. So, and P&A has grown by 17.5%, which is much higher than our 6 months growth of 13%. So overall, the volume has gone up and the regular also has started doing well. Most importantly is our luxury and semi-luxury segment has registered a sales of 100 crores for the first time in this quarter. Last 9 months, the total sale has been 250 crores. And going forward, we are very confident the way Royal Ranthambore is doing, Rampur, Jaisalmer, Sangam. We expect next year FY26 to touch 500 crore sales of the semi-luxury and the luxury segment.
What about gross margins? Because they expanded on a year-on-year basis, but there has been a 60 bips decline sequentially on account of the food grade inflation. Now, what's your outlook on that front as you go forward?
It's too early to say, but what I feel that the raw material prices has peaked and it will be on a declining trend. As far as the margin goes, our margin has been 14.2%, our EBITDA margins. And going forward, we feel for the next 3 years, each year we should increase our margin by 100 to 125 basis points.
Well, that would be good if that happens. 100 to 125 basis points improvement in margin on account of premiumization. You did speak about some of the brands doing close to around 500 crores together in the next year. Overall, what's your volume outlook for FY26?
Our concentration has been always on the P&A category and the luxury segment, where we expect to grow by more than 15% year on year for the next 2 to 3 years. And also, like the regular segment, we feel that the growth would be around 6 to 7%. And overall, we should have a growth of about 8 to 9% in volumes going forward. And EBITDA margins, as told earlier, is this year also we have increased by 150 basis points. So for the next 3 years, we feel that the EBITDA margin should increase by 100 to 125 basis points year on year for the next 3 years.
What's the situation that you're facing in Telangana currently? Because the other alcohol majors have been demanding their dues. So how's the scenario for you? How much is pending from the government side, and how have the discussions been with the government so far?
As far as the overdue goes, I think it will be a matter of months before which the government will clear the dues. And right now, whatever we are selling, they are paying the money.
And how much is pending from the state, if you could share that number?
See, right now, I would not have the figure at the top of my head, but I think it will be close to about 100, 150 crores.
All right, short on time, but not short on questions. Mr. Khaitan, we'll speak to you on another occasion, hopefully very soon. But until then, good luck for the remainder of this quarter and the next year as well. We'll take a short break, come back on the other side, get you more stock-specific action. Stay with us.
Still at 23,260 is the index, holding on to gains of about 100 points as we move further into the monthly expiry and we count down to the end of the January series. That's still remaining around those levels at around 23,250. But Olectra Greentech is one stock that has surged in the last few minutes, 11% higher now on the stock. Remember, it's an earnings reaction. It had opened higher and has now since then built on to those gains. Almost 12% higher now is Olectra Greentech. Also pull up SRF. Some positive management commentary coming in there with regards to the future of its various businesses, and that stock too has surged to the highs of the day, 4% higher on SRF. We spoke of Whirlpool as the top loser. What is also among the top losers now is Deepak Fertilizers, because after its results yesterday, the stock was up 14-15% and it seems to have given up almost all of those gains in today's trading session. That stock too trading at the lowest point of the day, 11% lower is Deepak Fertilizers. But take a short break. We get you more on the markets and specific stocks on the other side. Stay tuned.
Let's talk about jewelry. House of Rose has unveiled its new flagship store in Mumbai's Balad estate. Manisha Gupta caught up with Biren Vaidya, who's the managing director of House of Rose, to discuss key trends in the sector. What jewelry sector also expects from the budget 2025. Take a look.
The luxury customer is loyal to themselves and they want everything in every category. So though we started off the House of Rose with jewelry, we realized over a period of time that the customer was inclined to be going into other categories and other brands. So what we do best is be like water, get every international brand that is looking to come to cater to the Indian HNI and bring their products here in India.
Mr. Vaidya, when we talk about jewelry luxury, would you say this as a category has grown over the years? And if yes, would you be able to share a percentage approx number onto that?
So numbers is something that I really don't get into, because India has been a very dynamic market, and with the kind of population we have, whatever statistics that come out are only on very, very marginal slices, and that really doesn't give the whole picture. But the answer is yes, the luxury market has grown. The jewelry market existed right from the time when I started in the 80s, where though 1% of the population was paying tax at that time, 70% of the Indian population had more than 1 tola of gold. Okay, the Indian families. So that really showed how important jewelry was. However, saying that, the luxury category has expanded because today with the exposure to the younger generation through digital, through media, they have got a lot of exposure, education and wealth, and they want to enjoy it. And with the opening of the economy, you're seeing that happen. And from 5 cities, we have grown to more than at least 100 cities that can be called metropolitan cities.
Oh,
so
well,
it's highly
absolutely.
enjoyable.
So, Mr. Vaidya, from looking at gold and silver and jewelry and diamond as investment, where you're anticipating returns, when you talk about luxury jewelry, this is an area where you look at it as wealth creation and not exactly for returns going forward. Would you say category in that sense also has grown?
Yes, it has, because people have now got an understanding that it's not only the materials that create the wealth, it's also the goodwill of the brand. So for example, if you were to buy a steel watch, that also appreciates in price. So in the same way, when you're buying something precious that's in gold, diamonds, emeralds, and if it comes from a brand of a standing, the aspiration and the value goes up purely not because of the materials and the asset value of that, but also about the value and goodwill of the brand.
Rose, as you've created as a large enough brand of very strong repute and standing in the Indian markets, with budget around the corner, what is your expectation from this budget as a luxury brand, as a growing market, and also with the kind of business that you're in?
So every time, one doesn't have to always look at the government for something more. I think they've done an exceptional job on how they've positioned jewelry in luxury with the 3% GST. I think that's fair, and that should be okay with the size of the market that is going. But if luxury watches and luxury other products are heavily taxed, that will create the customer picking it up overseas. So if the luxury customer is willing to enjoy it and buy it locally, why not give him that advantage of picking it up here rather than going overseas and bringing it? I think that's one thing they should consider before they increase the GST on any of the luxury categories, because that is something that one tends to see happening. If they look at it from that perspective, is keep the purchases domestic rather than overseas, it would really, really help, and it would lure the market to grow here. It will lure a lot of international brands to come, and when more brands come, the markets get bigger. It's not only about imports, but it's also about exposure and people buying in India itself.
The Indian market really seems to be growing when it comes to jewelry, coming back to that. And we're looking at more corporates getting into jewelry as a business. There were a lot more IPOs in 2024 as well. And the way the jewelry market is talking to us, they tell us that there are 3,000 new shops opening in next 2 years. The expansions are coming in, etc. How are you looking at the sector overall and its growth?
So for me, jewelry has always been an art form. So one may talk about growth and patterns of scalability in the number of stores, but eventually one must understand, for it to grow in the correct direction, you need to have the right kind of understanding of design for the target segment that you are doing, whether it is mass or class. If it is generic, if it is just put out there to bring numbers, it really doesn't bring the value. If you see the largest brands in the world, even a brand like in silver like Pandora or Swarovski in fashion, they've identified their DNA. So by just opening stores is not the question, but like a child, you have to make the brand create its DNA, and with design, with innovative marketing, with strategy, and then it's easy to grow. But what I see is if things are done in a haste, where I see a lot of the Indian retail brands, especially in jewelry, growing, where they're going just with the herd mentality that if A has opened here, I need to open here. It may bring you business, but on an overall picture, if it's not identified with you as a brand, it is not going to work. So when you were to see a Cartier or a Bulgari or Rose that matter, there's a distinct style of jewelry. So a customer is coming for that. And when you see Pandora or you see any of the international brands, even the fashion jewelry of Chanel, it has its own style. So that is very, very important. You have to have a character, a DNA for the brand. It's not how many you open, but how well you manage it and strategize it.
All right, and while we were hearing that conversation, we had the numbers of Bajaj Finserv as well. The stock mildly in the red right now. In the early part of the day, it was doing well because of Bajaj Finance doing well. This is the holding company of Bajaj Finance. The company is approved an appointment of a CFO. Ramandeep Singh joins in as the CFO. But importantly, the numbers. If you look at them, the net profit has grown by about 10% The revenues also have seen a bit of a growth. So what we'll do is that we'll take net profit has grown by 3.5%. Revenue has grown by 10%, beg your pardon. For Bajaj Finserv, the more important numbers are the ones that come in the presentation and some more internal details. We'll await that, and as we do, we'll wrap up on this edition of Halftime Report. You stay tuned. Business Lunch will take all the action ahead.